Hi, everyone, and thanks for coming out to our webinar today. I'm Eliza Berry, Marketing Director at Richey May, and today we're going to be talking about loan officer compensation, employment taxes, and accountable plans. This is a really common set of questions that our speakers, Jenny and Gina, get asked about. So this is something that we definitely plan on everyone referring back to. This webinar is being recorded and will be available on our YouTube page either tomorrow or Monday. So if you are watching this in the future, thank you for tuning in. If you're watching today, though, this is eligible for CPE credit. So we will be launching poll questions throughout the presentation. There'll just be a slide and we'll launch the question. You need to respond to all 3 poll questions in order to get CPE credit. We process that. It can take up to 2 weeks to get your certification. So just stay tuned for that. They'll be emailed out individually with all of the NASBA documentation and all of that good stuff. If you do have a question during the presentation, you can post that either in the questions panel or in the chat. My personal zoo is sounding off right now. If you post a question in the chat or the questions, I will respond to it, or I will pose it at the end if we have some extra time. Any of those that don't get answered, I will go ahead and field those to Jenny and Gina and CC whoever asked it on the email. I know a lot of this is client specific, so if that's the case, then they'll just take that offline as opposed to answering it widely during the presentation. Their contact information will be available at the end too if you want to go ahead and proactively communicate with them, or you can email us at info@richeymay.com or contact us through our website. So with all of that admin out of the way, I know we have a lot of content to get through today. I'm going to hand it over to Jenny and Gina. So thank you again for coming.
Great, thanks, Eliza. Thanks everyone for joining today. We hope this webinar provides some value and some clarity on this important topic area. So today we are really reviewing the important connection between loan officer compensation and expense reimbursements. And we'll first discuss what these 2 areas encompass, and then we'll move into sort of common problems and share some insights on how these 2 areas work together, and then discuss considerations you and your team can make in either updating your agreements, reviewing your agreements, or other kind of practical actions to make corrections if needed. So we are really here, to discuss why loan officer compensation and accountable expense reimbursement plans are an important part of your success. Not only is compensation, a lender's largest expenditure, but outside of loan regulatory considerations, compensation is a highly scrutinized area by the regulators and the IRS. So due to the complexities of these 2 issues, they really do pose, a higher risk to your business if they're not done correctly. We know that loan officer retention is a critical success factor for you and your industry. And so in order to kind of retain that top talent, it's really finding that balance between motivating your people via compensation, benefits, and work culture, all the while kind of understanding what your peers may be doing and how they may be in the marketplace putting pressure kind of on your personal business strategy. Layering on top of all of that, you also have regulatory requirements of ERISA, payroll taxation, income taxation, CFPB rules, TILA and Reg Z, and varying state requirements. So really the complexities here are kind of boundless. So that's why we wanted to start the conversation here today, and we're going to focus really on the payroll and income tax considerations. So to start, what is loan officer compensation? You all know the basics, you deal with it on a daily basis, but we just sort of wanted to set a foundation here for this discussion. So the basic makeup of the traditional employee compensation structures include income for salaries, commissions, bonuses, sometimes deferred compensation. And historically, prior to the Tax Cuts and Jobs Act, your employees may have also been able to reduce these types of income by claiming miscellaneous itemized deductions on their personal return filings, which would have helped offset some of their earnings in their W-2. So with the Tax Cuts and Jobs Act, those miscellaneous itemized deductions are no longer allowed, at least through 2025. And this impacted, your largest employee base, your loan officers. So, if you made no changes to your compensation plans after that time or enactment of the Tax Cuts and Jobs Act, your employees may have felt like they've paid higher tax liabilities than they had in prior years. And they may have then just had more questions for you and kind of started reaching out, following up on what can they do to make a difference and maybe reduce their tax liability. So a lot of these questions I think we've been hearing around what loan officers come back to their employers with do revolve around the accountable expense reimbursement plan and kind of questions around how can they use that to complement their earnings or balance out their earnings. Having an accountable expense reimbursement plan in tandem with compensation arrangements or agreements really allows businesses to manage business expenses, but also provide that non-taxable reimbursement to its most important asset, which is its people. One concept that is often overlooked when it relates to loan officer compensation is the idea of constructive receipt. And, when it comes to salary, commissions, and bonuses, if the employee has discretion or lots of control as to when the timing of the payment may be available to them, that even though those funds may have been earned and payable at an earlier date, such as commissions, those are typically payable in that kind of normal payroll cycle, maybe it's 2 weeks in arrears or something like that, then that employee would have been considered to have received that income at that earlier date. So again, it's really important to understand that if there's that discretion or control given to the employee, that does create issues and challenges. This issue does also come into play if you have deferred compensation plans in place. So you do want to watch not only for those traditional kind of salary, commissions and bonus concepts, but also deferred comp. And the same kind of applies there, where if you have an arrangement that allows that, again, sort of discretion or control to the employee, that can really create a problem in a deferred comp arrangement. It can trigger additional withholding and reporting requirements, as well as potential penalties. So you do want to be mindful of constructive receipt and those rules when it comes to both compensation plans, accountable expense reimbursement plans, and deferred comp plans.
We had a quick question on this, which I think is relevant. Someone asked if you claw back money from an LO, can you reduce current comp, or is that an after-tax deduction?
I think what I'm hearing in that question is the idea of maybe having them return those funds back to the employer. If that's happening, that's actually an appropriate action if they're returning sort of unsubstantiated expense reimbursement funds that they may have received. If the question, if I haven't fully answered that question or not interpreting it correctly, we can certainly circle back on that kind of offline after the webinar. And we'll touch a little bit on some of the common problems and things that we see here just in a minute. So to kind of move into high level, what is an accountable expense reimbursement plan if you don't have one in place already? We, again, just wanted to set that foundation here. So basically, this is a plan where you have a mechanism to attract talent in sort of a different way, or to differentiate yourself from your peers or competitors. Getting this right can really make a difference depending on how you approach it and what options you choose to include in your plan. And these types of plans can definitely be tailored to your needs. We see often questions around, do we need one plan for the entire organization, or can we set it up based on role or production for your varying employees, production levels, or other needs? And you can definitely do those things, so you can have varied plans within the organization. The one thing you want to keep in mind with that is that it's just, the more plans you have, the more compliance you may have, and so more monitoring and tracking that may be involved with that. But when you have an accountable plan in place, what this allows is when the employees then substantiate those what are called covered expenses, the employer gets the deductible business expense, and then the employee gets the reimbursement, but it's actually excluded from their gross income. So it is a benefit that is really nice to the employee. So a couple of things that are important as you set up your plan and have your plan in place is having these 3 criteria as part of your accountable plan. Jenny will touch on this a little bit more in detail later, but these are the 3 kind of high-level concepts. So you want to have that proven business connection, adequate substantiation, so receipts and tracking of what is the expense, what was it for, and also in the event you have this component requiring employees to return excess advances that are not substantiated in that event. So really what I wanted to point out here is that in an accountable plan structure, if you're really saying something that would otherwise have been taxable wages, if you're just simply recharacterizing that or trying to call it a non-taxable reimbursement, that will not satisfy the accountable plan rules and that business connection component. So you do really want to be careful and mindful of how these plans are structured and how they correlate with your loan officer compensation and your accountable plan program. There are some anti-abuse provisions that also come into play, and some of that is around, if you have an employer established accountable plan, but there's this idea of evidences of a pattern of abuse of the accountable plan rules, all payments can actually be treated as made under a non-accountable plan. So that's where, the employee would not have that exclusion from gross income. And there can also be penalties that may be imposed in that scenario. So you do really want to be mindful of operating the plan as it's drafted and really having the policies and procedures in place to do so correctly. One of the other things that can come up in this area as well is in the idea of returning excess advances. If an employer is attempting to sort of bonus out those excess advances to employees as salary rather than requiring the return of those amounts, that doesn't work either. So you do, again, really want to operate the plan based on those 3 criteria of the business connection, adequate substantiation, and requiring the return of those excess advances. Pretty key critical functions there. The regulations do prohibit that idea of bonusing it out. And in that case, if you were doing something like that, your plan could be treated as a non-accountable plan, which could apply to all your employees. So you really, you don't want to lose that benefit by just having kind of one error in the plan. So here's where, before Jenny dives into the details, these are the common problems that we often see with lenders specifically, just because we've had so many conversations over the last couple of years. These are kind of the highlights of what we've really heard the most. Some are thinking of these plans as compensation set aside or banked. So you really, that's kind of not how these plans operate, and we'll touch on that later. Some employers also think of this as a way to pay out balances of this set aside amount or banked amount if it's not fully substantiated, say at the end of the year on an annual basis or something like that. So that can create a problem in the plan, as well as we sort of touched on in the last slide. Again, we've already touched on this a little bit, that idea of too much control or discretion given to the employees. That can be problematic. And then the other one, which this is a little bit more gray, but basically if employers are sort of indifferent as to whether those funds are considered taxable wages or expense reimbursements under an accountable plan, that can kind of create a scenario where if the IRS were to come in and examine those criteria, they might say it's taxable wages if you had treated it as an expense reimbursement under an accountable plan. So you want to be really specific and mindful with the types of expenses that are qualified and eligible for the accountable plan under this idea of sort of indifference. And then lastly is a common one we've also heard is just, how do you have the policies and procedures in place internally to ensure the integrity of the plan operation and to have the most successful outcome in the event of, any examinations in this area. And that can be, again, that additional compliance layer that sometimes is overlooked, but it can, especially depending on the complexity of the plan, can require those additional resources. A couple other things to keep in mind is reimbursing personal expenses or non-deductible expenses. Jenny will touch on those a little bit later, but those can also create problems in an accountable expense reimbursement plan. Just quickly, some high-level things to also think about as other industry issues as it relates to this are, not consulting with proper professionals on the setup or initial structure of your accountable plan. And this can also come into play with deferred comp plans as well. So you really do want to set them up as best as possible from the beginning if you can do that. There can also be that industry pressure to compete, and so that may also create practices that may not be in compliance with the rules and regulations. You could also have additional regulatory risk down the line. We know the CFPB, we're hearing comments that, well, maybe under the new administration, they may act more punitively than, say, under prior administrations. So these are sort of unknown risks, but could be out there. And then again, under IRS examination, they don't have a lot of resources right now, but they are still performing exams, and it may be that they're more in depth because they can do fewer of them with the resources they have. And so, this may be an area that they start looking at more. Hard to say, but it's definitely out there. So we are going to now launch our first CPA poll question. So please take a few seconds to pop through that if you were going to get CPE today.
Great, and that poll is live, so just go ahead and select your response. We'll give it about 30 seconds to be open unless we get all of you guys voting in there pretty soon. And remember, you do need to fill out a response to all 3 questions in order to receive the CPE credit. So we'll give it a couple more questions, a couple more seconds here. Go ahead and get those responses in. Great, all right, so I am going to close the poll. 64% answered 2018. Did they get it right?
They did. 2018 was the first year for the Tax Cuts and Jobs Act.
Good for you guys.
All right, so Jenny will now kind of dive into more detail on how compensation and expense reimbursement plans sort of work together with one another and some other factors to consider. So Jenny, please take it away.
All righty, so as you all know, mortgage companies employ loan officers to originate and to facilitate the processing and closing of mortgage loans. They are normally compensated based on some type of commission formula, and while some commission formulas are simple and are based upon a prescribed number of basis points multiplied by loan production volume, others are quite complex and involve specified percentages of gross revenues collected from loan closings and sales, less various production and sales related expenses. Mortgage company employers typically reimburse employees, including LOs, for ordinary and necessary expenses incurred and paid by the employees. Some commission formulas compute gross commissions payable to the LOs by subtracting reimbursed expenses from specified items of loan-related gross revenues. These compensation models are sometimes referred to as net compensation, net loan officer, or net branch type plans. Commonly, these so-called net compensation formulas also require a reduction to the specified percentages of loan gross revenues originated by an LO by specifically defined employer incurred and paid loan production expenses and allocable general and administrative expenses. Whether a net compensation model is properly determining the amount of taxable wages is not black and white. And in addition, significant potential adverse tax consequences, including substantial penalties, may apply in certain situations. However, there are certain steps that can be taken in order to present the best case for a valid net compensation model. And so basically, as Gina touched on earlier, in order for employee expense reimbursements to be excluded from an employee's gross income, the company needs to establish an accountable plan detailing the type of expenses that are reimbursable to the employees and set limitations for specific expenses where desired. The plan should be separate and distinct from the compensation plans that define wages, commissions, or bonuses. For an accountable plan to be valid under the Treasury regulations, the following three requirements must be present: business connection, substantiation, and returning amounts in excess of expenses to the employer. For the business connection requirement to be satisfied, the plan must provide for reimbursements only for business expenses that are allowable as deductions according to the IRS and that are paid and incurred by the employee in connection with performance of services as an employee of the employer. While it is also permissible to reimburse other bona fide expenses that are related to the employer's business, the reimbursement of these non-deductible business-related expenses must be treated as paid pursuant to a non-accountable plan reported as taxable wages. As a result of the elimination of the deduction for business entertainment expenses by the Tax Reform Act, the reimbursement of any entertainment expenses to an employee should be treated as taxable wages absent any contrary guidance from the IRS. Non-business or personal expenses, as Gina touched on earlier, should never be reimbursed as part of the plan provisions, since doing so can cause the entire accountable plan to fail. In this case, all expenses, even those that are valid business expenses, will be required to be reported as taxable wages subject to income tax withholding and employment taxes. So that's really something, and that's been something that we've had a lot of questions on, since I think there's a lot of times that entertainment were definitely things that LOs were reimbursed for, and unfortunately, much to our dismay, the IRS, when they did, or Congress, when they did the Tax Reform Act, for whatever reason, decided to make those not deductible. Revenue Ruling 2012-25 extends the business connection requirement to require that the reimbursement not be in lieu of wages that the employee would otherwise receive. Tax practitioners proposed that employers could use reimbursement and expense allowance arrangements to save both the employer and the employee employment taxes by restructuring their compensation packages to convert a portion of an employee's compensation into a non-taxable reimbursement. This structuring would permit employers to pay a lesser total amount while increasing employers' after-tax compensation. Some practitioners have asked whether a portion of an employer's salary may be recharacterized as being paid under a reimbursement arrangement. The final regulations clarify that if a payer arranges to pay an amount to an employee, regardless of whether the employee incurs or is reasonably expected to incur deductible business expenses or other bona fide expenses related to the employer's business that are not deductible, the arrangement does not meet the business connection requirement of the regulations, and then all of the amounts paid under the arrangement are treated as paid under a non-accountable plan, and thus no part of an employee's salary may be recharacterized as being paid under a reimbursement arrangement or other expense allowance arrangement. While an employer may establish or modify its compensation structure to include non-taxable reimbursement under an accountable plan, recharacterizing as non-taxable reimbursements amounts that would otherwise be paid as wages violates the business connection requirement, and more specifically, the reimbursement requirement. This is true even if the employee actually incurs a deductible expense in connection with employment with the employer. The presence of wage recharacterization is based on the totality of facts and circumstances. Generally, wage recharacterization is present when the employer structures compensation so that the employee receives the same or a substantially similar amount, whether or not the employee has incurred deductible business expenses related to the employer's business. An employer recharacterizes wages if it pays a higher amount as wages to an employee only when the employee does not receive an amount treated as non-taxable reimbursement, and pays a lower amount as wages to an employee only when the employee also receives an amount treated as a non-taxable reimbursement. There's a case called LL Mormon. It was a tax court case decided in 1956 that is still relevant, even though it related to tax years prior to several versions of the tax code being updated. In Mormon, the taxpayer's employment agreement contained the following provisions as it relates to expenses incurred and reimbursed by the company. You agree to limit your expenses of operation to the minimum necessary for the proper conduct of your business. The company will reimburse you for all of your expenses which we approve, including compensation of any people employed by you, traveling expenses, telegraph and telephone expenses, and entertainment expenses, but we will deduct the same from the commissions payable to you under this contract. A record of your monthly expenses is to be in our office no later than the 4th business day of the following month. Such expenses should be broken down roughly under the items of transportation, meals, etc., hotels, and sales promotion. If this record is received by us and the expense is approved before the settlement of your commission account for the previous month, we will exempt the total amount of your expenses from your monthly earnings in calculating your withholding tax on earnings. If we do not get this record from you, it will be necessary for us to take the withholding tax on your entire gross earning. A couple key points were made in the Mormon case. The corporation did not make any investigation to determine whether the amounts appearing on the expense accounts represented actual expenditures. The primary function of the monthly expense accounts was to enable the corporation to determine the tax to be withheld. The petitioner contends for the allowance of the deductions for these other expenses under Code Section 22 on the grounds that he had a reimbursement or other expense allowance arrangement with his employer. He refers to that portion of the employment contract which provides that the company would reimburse for all of these expenses. The court, in its opinion, stated, thus, although the contract states the petitioner will be reimbursed for his expenses, the claimed effect thereof as a reimbursement arrangement within the meaning of the statute is destroyed by the further provision that they will deduct the same from the commissions. In other words, making it a direct offset of the commissions, which is a big no-no. Okay, it looks like we're ready for CPE poll question 2.
All right, so that question is live, so go ahead and fill out your responses there. We'll let the people who answered question 1 get it all nice and filled in, provide about maybe 30 seconds or so to get that filled in. All right, great. I'm going to count you guys down, so make sure you get your response in if you want credit. 5, 4, 3, 2, 1. And I am going to go ahead and close that poll. Thanks, Jenny.
Okay. The answer, as I think you all now know, is the answer was A, no. Entertainment expenses are not deductible. In a private letter ruling, the business connection requirement is not satisfied when an employer changes their compensation plan to allow managers to elect either to maintain their current compensation without an expense reimbursement policy or to reduce their compensation by some percent in exchange for having the ability to be reimbursed for business expenses incurred. Or when the business expense reimbursement they could claim were capped to equal the amount of compensation reduction and were expected to be achieved, so they always got paid the same total with more of it non-taxable. The IRS has explained that the manager is making an anticipatory assignment of future income to the employer for consideration, the reimbursements, and that the reimbursements would be includable in the manager's compensation. The private letter ruling guidance illuminates a key factor to avoid in developing a compensation plan. The company should develop and enforce the plan with no employee influence, elections, or choices. While private letter rulings are not substantial authority and are only applicable to the taxpayer that requested the ruling, they do often indicate the IRS position on issues. This ruling and discussion went so far as to state, this example also illustrates that in order to have an accountable plan, Section 62C of the code and the regulations thereunder contemplate that the reimbursement or other expense allowance arrangement provided by an employer should be amounts paid to the employee in addition to salary.
And that's really the key here, is that, you know, we have, I think, seen plans where employers, you know, develop a kind of a structure where they can participate in the plan, but the key is to think of it as above and beyond compensation. So it's not, here's your comp and we're going to reduce it so that you're part of the plan, but it's here's your comp and then above and beyond that is your expense reimbursement.
In most net compensation models in the mortgage industry, the company is indifferent as to whether or not certain expenses are incurred by LO, as the expense amount directly offsets the commission or bonus the company will then pay as taxable wages. In fact, the company may be motivated to reimburse more business expenses as long as the total cash in wages and expense reimbursements to the LO is not increased, since the company pays less in payroll taxes. As a general rule, the company should eliminate employee discretion as to incurring expenses, or such amounts may be considered to constitute taxable wages. Employee discretion and company indifference could result in all expenses under the accountable plan being deemed under a non-accountable plan with significant additional taxable wages and payroll tax liabilities. I think that's kind of the underlying message here. And this is something that we've seen that in the mortgage industry, I think is a real struggle, is that to actually recognize that the LOs are not the ones that can actually make the call on this. It has to be made at the company level. And that's tricky, you know, in the whole retention concept. Mortgage companies should evaluate their current LO compensation plan and assure there is not an appearance of an expense being a reimbursement in lieu of wages. Additionally, if amending the LO compensation plan, the company should be careful to not present even the appearance that an LO's compensation is being reduced in exchange for the ability to have additional expenses reimbursed. I have a couple more cases here. I'm just going to do a little bit of a summary since we kind of delve into the Mormon one a little more, just kind of to reinforce some of these points. In American Airlines versus the US, American Airlines provided flight crews a per diem rate for meals and overnight stays and excluded the amount from the employee's income. The IRS argued that American Airlines did not have adequate proof that the per diem rate was the amount reasonably expected to be incurred and therefore did not satisfy the travel expense regulations, income tax withholding, and FICA tax withholding respectively. This is to note, this was American Airlines creating their own per diem rate. This wasn't using the government's pre-done one that they put out, which is a different situation. The court held that American Airlines cannot rely solely on whether an employment agreement identifying reimbursable amounts can reduce gross commissions, but not whether advances for expenses to be incurred are reasonably expected to be incurred. In the Trucks Inc. versus US case, the court links the travel expense regulations wording that a business expense be incurred or reasonably expected to be incurred to the business connection prong of an accountable plan. In this case, the employer for truck drivers calculated a per diem amount for travel expenses off a general standard practice in the business industry. The next prong is substantiation. The second requirement to having a valid accountable plan is substantiation of business expenses. Substantiation under the code requires the amount, time, place, and business purpose of the expense, as well as the business relationship of any persons entertained or receiving a gift. Any other expenses require that sufficient information be provided to the employer to identify the specific nature of the expense to reach a conclusion that it is attributable to a valid business activity. And the third requirement is returning amounts in excess of expenses. The third requirement in order to have a valid accountable plan is returning amounts in excess of expenses. If the employer arranges to provide an employee with an advance of monies for a bona fide business expenses, the plan must require the employee to return to the company any excess amount of advances within a reasonable period of time. A reasonable period of time depends on the facts and circumstances, but a safe harbor exists that is satisfied if the advance is made within 30 days of the expense. The expense is substantiated to the employer within 60 days, and the excess is returned within 120 days after the expense. So here are some conclusions and recommendations. The accountable plan rules contained in Treasury Regulation 1.62-2, as well as other rulings and court cases, make it clear that taxpayers are not permitted to structure compensation plans that recharacterize taxable wages as non-taxable expense reimbursements. Compensation plans in existence or being modified to achieve this result, where the employer is economically indifferent or perhaps motivated through payroll tax savings and employee relations, may find themselves facing significant payroll tax assessments for underreported wages, along with penalties for late deposits every pay period on a large number of employees. In addition, penalties of $200 for each incorrect W-2 reporting of wages could also apply. Such an assessment could be significant since it could apply to a large number of employees, numerous pay periods with late deposits, and all years open for examination, which is generally 3 years. And it's also important to note that the payroll penalties, the IRS payroll penalties are usually much more severe than the income tax penalties. So you want to definitely avoid this because it will hit at the employees as well. And that's never happy when they hear from the IRS. We recommend that companies establish accountable plans and set limits as necessary on total expenses that will be reimbursed for certain expenses to meet company goals, i.e. marketing expense reimbursements capped at a specific dollar limit per month, year, pay period, etc. Business meals similarly capped if desirable, and other. The accountable expense reimbursement plan should only address expense reimbursements and should be separate from employment and compensation agreements. The company can maintain more than one accountable plan such that executives, LOs, or branch managers are subject to a specific plan for their category of employment, or even there could be separate ones for different LOs based on production value, or you can have several different ones based on whatever category you choose to create. It is important that the company generally controls the type of expenses eligible for reimbursement and the approval process rather than processes where employees' discretion is significant. We strongly recommend that employers do not directly calculate taxable wages by offsetting commissions with specific expense reimbursement to achieve complete economic parity. The regulations, rulings, and cases all recognize that the company is generally indifferent as to the amount or type of expense incurred in these situations. Without additional guidance from the IRS, we also recommend that business entertainment not be reimbursed since this is no longer deductible, and current regulations require the company to include reimbursement of entertainment expenses in taxable wages. This is true for other business expenses that are not deductible as well. Personal non-business expenses should never be reimbursed pursuant to an expense reimbursement plan, as doing so can cause all expense reimbursement to be taxable as wages, regardless of whether or not the reimbursements during the year would otherwise qualify to be non-taxable. When a company desires to incorporate expense reimbursements, company general and administrative expenses, or back office support overhead charges in setting commission formulas, we recommend taking a different approach to direct offsetting of expenses in complex compensation formulas. The goal of perfect offsets has significant risks given the rules regarding wage recharacterization. Instead, we recommend companies carefully set up accountable expense plans with control over the types and limits for reimbursements first. Then the company can estimate this annual cost plus the amount of any other overhead allocations that it wants to incorporate in the calculation of commissions or bonus amounts. This annual cost could then be broken down as a fixed dollar rate to be subtracted in the commission formula. It could be set to occur per pay period and could also be at different monthly rates to account for higher and lower production amounts, but is always a fixed amount that is not directly tied to any specific expense amounts reimbursed under the accountable plan. For example, a commission formula may be structured as a specified number of basis points times the production less $100 per pay period for overhead, and could be set at different rates to reflect variance in high production months and historically lower production months. While it does not result in perfect matching, it achieves similar economic results with no direct correlation to expenses reimbursed that could violate the wage recharacterization rules. It is important to also recognize how important it is for companies to be able to substantiate the expenses and it reimburses to employees. Failure to have supporting documentation for an expense that would otherwise be deductible results in the amount reimbursed being treated as paid pursuant to a non-accountable plan, which is required to be reported as taxable wages. For example, charitable contributions require specific documentation, including a donor acknowledgement letter supporting that the company has made a tax-deductible donation. Donations in excess of $200 require a written acknowledgement from the charity, and this can be difficult to obtain when these are being reimbursed to the LO, and the charity may even issue the letter in the name of the LO rather than the company name, which is incorrect. It needs to be in the company name. Reimbursing of this expense without the required documentation, as with the reimbursement of entertainment expenses after 2017, results in taxable wages and withholding obligations on the amount reimbursed. And this is kind of a little bit of a summary on accountable plans, just some basic things to keep in mind when you're creating one. Direct offsets do not work from a payroll perspective. This is especially true in the lending industry, as businesses are so focused on retention, they are likely to give in to LOs in ways that other industries do not do with their employees. The company also does not want to track expenses against commissions, as these should be separate pieces of compensation and expenses. Effectively, there should be no allocation balance. Monitoring amounts by employee will be best practices for budgeting and planning, but not to track against commissions. When an LO's commission, which is W-2 wages, is reduced dollar for dollar by any business expense reimbursement pursuant to an accountable plan, which are typically tax-free fringes, the IRS considers this a recharacterization of what otherwise would have been taxable wages. This is because the IRS views the employer indifferent in this situation, as the company is paying the employee the same either way. If an exam is performed and the issue identified by the IRS, the company can be subject to significant penalties for late payroll tax submissions and underreporting. What is important to apply in these structures is for the LO compensation agreements related to commissions to be separate and apart from the accountable business expense reimbursement plan. On the LO compensation agreement, the employee can select whether they elect to participate in the accountable plan. And if they do, the company can draft a separate participation agreement for the accountable plan. The accountable plan would be a company-wide document that is referenced for policy and procedure. Examples are what types of business expenses they would reimburse. Note that the separate participation agreement can be simple. It just designates the dollar amount the company is willing to reimburse with any caps. If the LO elects to participate, the company can also consider different commission rates if desired. Or if the company intends to have all LOs participate in the accountable plan, the company will just need to reference that in the LO compensation agreement and then discuss the caps in the participation agreement. The company should ensure that as much discretion as possible is removed from the LOs, and that as long as expenses qualify for reimbursement from the plan, meet the employee cap, they are within the guidelines of the accountable plan. There is no official guidance that this approach at least results in no direct match of these amounts, since the amounts of compensation they give up is unknown based upon production, even though the actual amount of expense reimbursement may be capped and expected to be fully utilized. This uncertainty means there may be winners or losers, as some LOs may have given up more or less compensation than they can have reimbursed through the accountable plan. The next slide is a summary of the changes that happened to the meals and entertainment expenses under the Tax Reform Act, what the old rules were as 2017 and before, what they are now until 2026. Well, who knows with the election, but as it's set to be, what the new rules will be when these will go change and what will be the case in 2026. This will be included. We also can easily send this if anybody would like to just have it handy. It's kind of nice to have that information. And then I think we have our next CPE poll question.
Great, so I went ahead and launched that question. We have gotten a couple of questions that are specific to each client, and I've responded to most of those. I am starting email threads for you guys with the speakers, so if that's a response that you've gotten from me in the question panel, look out for those emails after the webinar, and I will CC our speakers in there so that they can respond to them specifically. So again, keep them coming. Thanks for sending those in. And for those of you asking, yes, a copy of the slide deck will also be included with the recording. So that will be sent to everyone who is registered. And then if you're listening in the future, it'll be available either in the video description or the blog post, depending on where you're looking at this at that time. So looks like we got all of our responses. So I'm going to go ahead and close the poll question. We had 100% answering yes on that one.
Oh, very good. All righty, well, I think Gina's now going to kind of go through and summarize some final thoughts. And so here you go.
Yeah, thanks, Jenny. So this is really kind of the action items, I guess, that we would say here are the takeaways for you to think about here after you've maybe listened through a lot of the technical jargon that we've thrown at you. But, you know, really what I think is important to take away from this is just that idea of, you know, these documents really do ebb and flow with the needs of your company. So they do sometimes need to be revisited if you've had a plan in place for decades. You know, this might be a good time to start thinking about, you know, is it meeting your business needs? Is it meeting your employees' needs? And reviewing not only your compensation agreements for, you know, that retention concept, but also for compliance. And same would be true for your accountable plan documents as well. You know, we talked a lot about those risks that are in play with just, I mean, we talked specifically about income and payroll tax risks, but there are many more that come into play, as we touched on kind of early on in the slide deck. So, you know, this is really an important area for you all to consider and think about, is it meeting your business needs? The other takeaway is, you know, once you've gone through that exercise, you know, are there any problems that you identified for maybe plan corrections and as it says here, and risk mitigation? Again, you know, periodically reviewing these and then trying to take that corrective action, I think really does show that good faith effort to always kind of be rethinking the plans, especially as tax law may change over time. So definitely a good practice to have in place. And then to the extent you do maybe see some issues with your plan, seeking that sort of third-party guidance, whether legal or tax specialists, to help you hone in on how to best correct things. Or if you don't have a current accountable plan in place, you know, thinking about whether or not it would work for your business, you know, talking with a third party to help draft those documents, you know, is definitely an important part of kind of maintaining that competitive strategy. So we definitely wanted to mention that. And Richey May can definitely assist in working together with your legal teams or other providers to review tax compliance in those documents. We are, though, unfortunately not able to help draft them, just as we are not kind of legal counsel to execute on that side of things. But we're definitely here to kind of help support you in that process. So please let us know if you have any questions or follow-up on that matter. So those are kind of the takeaways and action items. And if there are any more specific questions, maybe to your business needs or follow-up, please feel free to reach out to Jenny or myself. Or as it says here, you can contact info@richeymay.com, and we will definitely make sure to circle back with you and help work through your questions. I think that's everything we had today, so we really appreciate your time. And Eliza, I don't know if there was anything else that you had to share on CPE or otherwise, it may be a survey to follow up after the webinar.
Yes, just as a reminder, I'll be starting those email threads. So I've already pretty much got them filled out. So I will pull your email if you asked a question in the chat and we didn't get to it in the presentation. The CPE certifications, again, just be patient with us. They can take up to 2 weeks to send out because our admin usually has to go through, you know, each one of your answers and send that out the appropriate way from NASBA. The email with the recording will either be sent out tomorrow or on or anytime really before Monday. We typically do these on Thursday, so I realize I've been saying Monday as though it's like this coming up Monday, but probably this week, so either tomorrow or the next day for the recording and the slides there. And that also can be shared with anyone at your firm that you think might benefit from this information. So it'll just be, you know, easy to share that video or forward the email with all the links in it. And everyone who registered will get that link. So thank you for everyone who joined us today live. And then obviously for those of you joining us in the future and watching the recording on replay, again, feel free to reach out to Gina or Jenny or that info email address, which is actually me. So we will catch you guys next time we do a webinar, and thank you for joining.